Okay, so if you're a real estate investor, you know the feeling. You've just made a fantastic sale, but then, boom, a huge tax bill comes along and just gobbles up a massive chunk of your profit, killing your momentum. But what if you could legally hit the pause button on that tax bill and reinvest the entire amount? Well, today we're diving deep into one of the most powerful tools in the entire tax code for doing exactly that, the 1031 exchange. Here's what we're going to cover. First, we'll talk about the big tax problem that holds so many investors back. Then we'll unpack the 1031 solution, get a handle on its super strict timeline, and see the real power of tax deferral in action. And finally, we'll arm you with what you need to know to avoid some of the most common and costly mistakes.
All right, let's set the scene. You made a really smart investment. Your property has gone way up in value, and you just sold it for a fantastic price. This should be a moment for celebration, right? Well, almost.
So here's the big problem. That giant profit you just made, it comes with an equally giant tax liability. Capital gains tax. And this can take a serious bite out of your cash, which means you have way less money to roll into your next, hopefully even bigger investment. It's a total drag on your growth. But what if you didn't have to write that check to the IRS? At least not right now. This is where the tax code actually throws savvy investors a lifeline. Let me introduce you to Internal Revenue Code Section 1031. Now, the most important word on this slide is defer. You've got to understand this isn't tax forgiveness, it's a tax postponement. You're basically kicking that tax can down the road, which lets you put 100% of your gains back to work growing your portfolio.
So what can you buy? You see this term like kind, and you might be thinking, oh, so I have to trade a two-bedroom condo for another two-bedroom condo? Nope, the definition is actually incredibly flexible. You could exchange an apartment building for a plot of undeveloped land or a warehouse for a strip mall. The only real rule is that both the property you sell and the one you buy have to be for business or investment. That means your personal home or a quick fix and flip project, they're not going to qualify.
I love this quote because it just perfectly sums up the power of a 1031. Think about it. All that money you would have sent to the IRS for taxes, it's now working for you as part of your down payment on the next property. It's literally like getting an interest-free loan from the government, which, as you can imagine, massively boosts your buying power.
But all this power comes with some very, very strict rules. And when I say strict, I mean it. With a 1031 exchange, the timeline is totally non-negotiable. There is zero room for error.
The clock starts ticking the second you sell your old property. From that day, day zero, you have exactly 45 calendar days to formally identify, in writing, the properties you might buy. And we're talking calendar days, so weekends and holidays count. Then, you have a grand total of 180 days from that initial sale date to actually close on the new property. If you miss either one of those deadlines by even a minute, the deal's off, and your tax deferral goes right out the window.
And beyond that tight timeline, there are a few other critical rules. The name on the title for the old property has to be the same as the name on the title for the new one. You have to buy a property of equal or greater value, and you've got to reinvest all the equity. And maybe the biggest rule of all, you absolutely, positively cannot touch the money from the sale. The funds have to be held by a neutral third party, called a qualified intermediary, or QI, from the moment you sell until the moment you buy again.
Okay, so you've navigated all those tricky rules. What's the big payoff? Well, this is where it gets really, really exciting. Let's actually look at the numbers.
Just look at this side-by-side comparison. In scenario B, you pay the taxman and your equity for the next deal shrinks. But over here in scenario A with the 1031 exchange, you keep every single dollar of that equity working for you. This lets you leverage that extra cash into a much bigger property. And when you keep doing this, daisy chaining one exchange into the next, that gap in your wealth and buying power just gets wider and wider.
The difference here is just staggering. After only 2 deals, the investor who used the 1031 exchange has almost $500,000 more in purchasing power. That is the wealth compounding magic of tax deferral right there. So this all sounds amazing, right? But I know what you're thinking. Does doing a 1031 put a giant target on my back for an IRS audit? Let's talk about the risks you need to be aware of. First, let's just put the whole audit fear to rest. The truth is, the audit rate for 1031 exchanges is less than 1%. That's pretty much the same as for any other real estate deal. So just doing an exchange doesn't automatically put you on the IRS's radar. Making mistakes, however, definitely will.
So while audits are pretty rare, the IRS does look for specific red flags. This is stuff like simple paperwork errors, missing those critical deadlines we talked about, or trying to use your new investment property as a vacation home too soon. Another big one is incorrectly handling any extra cash you might take out of the deal. That's called boot. The bottom line is, being precise and keeping great records is your absolute best defense.
And that brings us to the single biggest long-term risk, what I call the tax bomb. You have to remember these taxes are deferred, not forgiven. So if you daisy-chain these exchanges for decades, building up a massive amount of deferred tax gains, and then one day you decide to just sell a property and take the cash, well, you're going to face an enormous tax bill on all of those accumulated profits, all at once.
So what's the final word here? Is the 1031 exchange some kind of magic tax loophole? Not really. It's a complex, powerful financial instrument that absolutely demands precision and careful planning. For the disciplined investor, it is an incredible tool for building wealth. But for someone who's unprepared, it can be a trap. The question isn't just can you use it, but really should you? The responsibility and the opportunity is all yours.